Hello, this is Bill Moreland with BankRegData. Today I'm going to spend a little bit of time talking about mark-to-market losses. Interest rates are up 25 basis points as of, this is May 28th, around 4:30. We're up about 25 basis points higher on the 10-year than we were at the end of March 31st. So of course, the mark-to-market losses on the bank books starts making the round, and I get a bunch of questions. And that's good. It's good that there's an appreciation and understanding for how current rates will affect it. I'm less concerned about it than I once was, which may sound weird considering I'm the kind of the Pied Piper of doom on most things. But I do think that it is getting better. Now, obviously, in individual situations, and we're going to take a look at Prosperity Bank to walk through how I would look at it. There are going to be situations, but in general, the chart that everyone's worried about, I'm going to go to the industry and I'm going to go to securities data and I'm going to look at appreciation, depreciation. And you'll notice this is the AFS plus HTM. That's available for sale plus held to maturity. The FDIC doesn't think in terms of mark to market. They call it appreciation, which means it's a gain. Depreciation mean it's a loss. So if it's minus 413, the net is the banks are mark to market. Paper losses are $413 billion, which seems alarmingly high. But look at the trend, right? The trend is basically that the number is improving every single quarter, right? You're going to have interest rates driving some of this, why the 364 was so low. And then it's back up, and then rates went down, and then it's back down. Rates are up, so the number will be like 440 if we were, June 30th. So there is that fluctuation, and the 10 year is just a proxy. We don't really know. But the trend is improving, and it's improving for three reasons. One is maturation. So we're now 2.5 years into this higher rate cycle. I would consider it a normal cycle. But I'm fully aware that anyone under 37, 38 is, they think zero is normal, and we'll see how this plays out. But in an environment where rates are higher, basically they will mature. So as the securities mature, regardless if the rates are higher or lower, they're higher than what they were when they bought it. So if they bought a maturity or security at 2.5% for 3 years, and now it's matured, they can roll that money back over into a higher yielding security. So that is the second reason, which is dollar cost averaging, right? So you have maturation, you have rolling over maturing securities into higher yielding securities, which will bring that yield higher. And you also have new money at play. So as banks grow and deposits come in, they basically can go out and buy higher yielding securities because they're more attractive, or they can park it at the Fed. But basically you're getting a reduction in the loss because of maturation, dollar cost averaging, and frankly, because banks have just taken a ton of losses. This is realized. So this is under income and expense, securities gains and losses realized. So a negative number is massive. 2 billion in losses, 3.3, 3, 9. And you had some banks out there that were basically like Key Bank. They were eating $900 million a quarter for a couple of quarters. You had Truist a couple of quarters. It was like 6.5 billion. That's that big number right there. This is not my wheelhouse. I am not going to be someone who knows the strategy behind it. I feel that some people are some banks are making that decision because they want the market to respond better if their mark-to-market losses securities go down. I don't know that is or not the case. I don't think banks should be doing that, but I understand the motivation behind it. But it is healing across time. So what we're going to do is we're going to take a look at Prosperity Bank. There's nothing magical about them. They're just a good sample for a number of things. The general questions are going to be, we need to look at mark-to-market losses and we need to look at insured deposits. And I'm like, yes, you need to look at them. But those are not the ratios that we teach our clients. And we have probably 80, 90 counterparty risk treasurers, right? They manage 10 million, 20 million, 100 million, 180, one of them. So when they call up and say, look, what is it that you should look at? Like, yeah, let's go take a look at securities. So we go into their security book, we go into their appreciation, depreciation, and we see that their mark-to-market losses right here are $1.15 billion out of $10.79 billion for 10.71%. So they're basically, securities worth 89 cents on the dollar. And yeah, that's a big number, but the trend is holding, right? The industry's healing. You start to see that they're healing. But 1.15 is a big, big number. What I tell people to look at is this upper right table. This is if they had to liquidate their entire securities book of $11 billion. Worst case scenario, absolute worst case. If they had to liquidate it today, they would basically lose 31% of their tier one capital. Then the question is could they afford to do that, right? Would that be crippling or would they be fine? I mean, wounded, surely, but fine. So look what happened across time. If we go back to when rates were going up, right there. So Silicon Valley Bank is 2023 Q1. Their mark-to-market losses were 40. The prior quarter, they were 49 and 47. They're technically bankrupt, right? We didn't know it. No one talked about it. But if they had to lose half their capital, there's no way they'd probably survive. That number got as high as 53% of their total capital. But now that number's down to 31. So the question is can they afford to eat 31% of their capital? And there's their capital ratio right there. So there's their 31, right? Securities appreciation. So it's on our main page right here. That's an ugly number, and that's in the bottom 20%. So 80% of the banks are not losing that much money as a percent of capital. There's their mark-to-market, 89 cents on the dollar. But look at their tier one capital, their tier one, their CET1. By the way, most banks are identical. Like 95% of the banks, they're identical. So if you came in and you looked at them, 31% would probably get them down to 11.5, right? 10, 11.5. They'd be fine. There are plenty of banks down here at the bottom, their size, that are sitting there at 10.5 and 11. Not a ton. They probably, the regulators probably wouldn't like that. The market wouldn't like it. But in the absolute worst case, this is not crippling. However, most people will go in and look at the mark-to-market losses and come in and look at, I'm going to deposit data, look at insured. And they're sitting at 60, 60, 60, 60. I don't focus on this number. And I know that sounds absolutely crazy, but you got to view it as a bell curve. And if you're on the bottom of that bell curve, like Silicon Valley Bank was at 30, 25, 30, 35%, that's concerning, right? If you're on the top of that curve at 88, 90, 95%, then that's comforting. And so, but that big chunk of banks in the middle between 50 and 70, and these are estimated. These are not, the banks don't know this. It's not like an easy number to calculate. And I hear a number of banks basically say, well, that just doesn't include our IntraFi network. I mean, this doesn't include deposit sharing, right? So I understand the focus on it, but I'm less, and I understand the bank's trying to say the number doesn't matter, but not matter as much. But being intellectually honest, I would basically say 55, 65, 70, I don't see much difference. Really what I would focus on is, I already talked about mark-to-market losses as a percent of capital. Absolute worst case, they can survive. But what I also tell our counterparty risk treasurers and our investors is basically go look at their core deposits. Are their core deposits stable, going down, going up? So there's the flood of money, $5 trillion of new money came in 2021, 2022. Some of that flooded back out as rates weren't competitive. But since that time frame, and actually since Silicon Valley Bank, they're rock solid, 26, 26, 26, 26, 26. So would I like to see the number go up? Of course. But am I worried that if I had money in this bank, that other people are rushing for the doors before me? Nah, I don't see that. That makes me feel a little bit more comfortable. The other thing is cash. And I love cash. I love pushing this metric because basically cash is important for a couple of reasons. Notice how they held almost no cash. And look at that. 100 basis points, 132 basis points. That's criminal. I mean, I don't think it's criminal, but we should never have gotten to the point where banks are holding 1% cash and that's acceptable. But the problem is we kept our finger on interest rates for 11 years. Banks got used to it. They were punished if they held cash, and cash is at zero. It doesn't earn anything. But there's two reasons you want to hold cash. And I don't know the right number, but it ain't one, right? There's a reason you want to hold cash. The one is guys like me are worried. Now, I don't have any money, but the guys that I work with and our clients, if they got $20 or $30 million, can they go in and get their money out? So let's say you had $120 million with this bank right there. Are you comfortable? Probably not. Because if enough people run for the doors at the exact same time, there's not a lot of margin. What did this bank do? They started raising enormous amounts of cash, right? They weren't investing in securities. They weren't basically investing in loans. They were basically going out with a lot of that cash and keeping it. So one, that's smart. And I actually like that. And I would tell anybody that was a counterparty that had money in this bank, there's a lot of things I don't like about it, but hey, their mark-to-market losses are coming down. They have enough capital. Their core deposits are stable, and they get it. They get it. You're not really in a situation where you could see a bank run happening based upon the numbers that I'm looking at. So there's a second reason they should have wanted to hold cash. And that's when rates went up. So go back to cash. Where are they holding it? They're all holding it at the Fed. 80% of their cash is sitting at the Fed. And you see that number got as high as 1.92 billion. Well, why is it coming down? Well, I can tell you why it's coming down, because it ain't 5.4% anymore, right? It's come down 100 basis points. So if you go to yield and you go to balances due, that's money from the Fed. I mean, there's your, the number. This is an average 2-quarter, but you can see those average 2 quarters come pretty darn close to this. And especially when you look at the yield, 540, 540, 540, right? In the ballpark. So that is one of the reasons this bank went out and wanted to get a lot of cash. One was basically making sure that their depositors were comfortable, that they had enough money in the tiller. Two is it was very profitable doing that. So this bank, by all accounts, I'm not worried about it from a mark-to-market risk perspective. But I am worried about their securities portfolio. And so it's probably not for reasons that you would expect. So come back into the balance sheet at asset review. We already know that they're trying to get their cash number up, but look, they hold almost $11 billion of securities, 27% of their book. So if we come into securities and we come down, we see that that's basically sitting in 85% of the banks, 86% of the banks hold less cash. And Ameriprise, Beal, and Optum and Frost typically aren't your normal commercial and retail bank. So they're pretty much maxed out. Well, what are they holding? They're holding, I go to Securities data, they're holding all mortgage-backed securities. It is an enormous amount of mortgage-backed securities, which is long dated. That's the rub. That's why I'm a little bit worried about this portfolio. Not about their mark-to-market losses, but their mortgage-backed securities. Look at the number. They're trying to get that number down, and they're doing a pretty good job of it. But the 28% basically is unheard of, right? I mean, Ameriprise is not a traditional bank. They're at the extreme levels. And for a while, they were rocking 38, 39%, which is an enormous amount. That would have been unheard of when you're looking here, right? Some of these guys may have been higher going back in time, but that 39% is extreme to the end. So why am I not fond of it? Well, the reason is it's going to break their ability. I'm not saying they're broken, but I said it breaks their ability to generate interest income because I'm going to bet you it's all long dated. And I could look at that looking at maturity. That's their non-mortgage. There's their mortgage back. And it is. 94% of it is greater than 6 years. So basically, their entire book is long dated. And what that means is when they bought it, go to yield, go to securities, it wasn't earning anything. So their ability to generate net interest margin is incredibly constrained, right? This is why securities are an issue for Prosperity. It used to be their mark-to-market losses were bankrupting them, because a lot of banks were technically bankrupt back in 2023, but that's not as big an issue. And this is a companion video to our X.com and LinkedIn posts. And I'll talk a little bit about Prosperity Bank, but basically holding so many securities and long dated basically hurts their ability to generate interest income. So 205, 207, 210, I pop down to the bottom. They're in the bottom 10%. So 89% of the banks generate more out of their portfolio than they do. Look at the peer number, which is all the other banks closest in their asset size. The black line with the black dots is that weighted average of the peers. It just keeps getting higher and higher and higher. That spread is lost opportunity. By holding so many as long dated, and there's plenty of reasons for doing that, and I'm not as educated as I potentially should be in that area. So I'm not saying it was a horrible decision, but what I'm saying is it's putting handcuffs about their ability to go to net interest margin, income and expense, net interest margin. It closes their ability to generate higher net interest margin when such a large percentage is basically coming from mortgage-backed securities. So there is one other issue I have with this bank. It's not securities, but it is, and I'm, as I mentioned, I'm becoming the Pied Piper of doom. It's their loan portfolio, right? So there looks like there was an acquisition. They get to that $21 million mark. They are $21 billion. They've stayed there. Notice how their delinquencies have started to climb. And then they kind of cap out, which is good, right? It's good. But notice how at the same time that they cap out, they start to elevate their modified loans. So this is the playbook, especially among the larger banks and the publicly traded banks, and I'm pretty sure it's a coordinated effort, is they're basically going in and they're saying, look, our delinquencies are very good, 78, 80, 88, 87% basis points. But what's happening here is they're starting to modify a bunch of loans, and those loans are not being put on non-accrual. So these are loans that are just lowered payments. So their mark-to-market losses aren't the big concern. Their securities portfolio basically being a constraint or a handcuff on their income generation ability for net interest margin is. But what you're seeing here is this bank is starting to modify loans. It's a gateway drug. That's why I call it this. So essentially what we're looking at here is the more you do it, the more you get used to doing it. And it becomes easier, and then it stabilizes, and then it goes up, and then it skyrockets. And then it becomes the de facto way to keep a lid on your delinquent loans. So what you're doing with these modifications is you're lowering the payment so that the borrower can continue to make payments and stay current. And so what do you worry about? Well, you worry about it going from nothing to basically 45 basis points of their portfolio. Is that alarming? Well, yeah. Once you start getting up a 1.5%, it is alarming because banks don't keep but 1.5% of reserves when you start to modify more than you're reserving. But the trend, look at the trend. Look at what they're doing. So let's go in. Are they doing it across a bunch of stuff? Yeah. Where's it at in the last 10 years? All-time highs. They've never done this before. So you see how all of a sudden this is something that they're using. Well, let's go in and take a look. Construction other. Well, that is a mistake, right? See the zero right there? So they started to do more, and then it kind of stopped, And then it was 7.163, 7.163, 0, 71.63. I guarantee you that's a mistake. That should have been 71.63. They just didn't file it correctly. But notice how the dollar amount's not coming down. It's identical. So is that interest only? Perhaps, right? Maybe that's an interest only loan. But that's an interesting observation, right? From a risk perspective. All right, other portfolios. Yep, gets easier. So clearly that's one guy they modified last, probably one or two loans. And is it making payments? Yeah, made $21,000 of payments. The principal came down $21,000. But now you're seeing two portfolios. Well, let's go down and take a look at C&I US addresses. Are they getting the habit of doing it more? Yes, they are. So we now have three separate portfolios. Two of them significantly increased in the last 2 quarters. Well, the big one is the non-owner occupied, right? So we're reporting in delinquencies. They look great. Our delinquencies are 57 and 54 basis points. And we just keep growing that portfolio, but then we've kind of stabilized it. So that number is stabilized, but our delinquencies look good. So we have $17, $18 million of delinquencies. Meanwhile, that's probably one or two guys working their way down, and then that number goes up $35 million. So instead of reporting basically 54 basis points of delinquency, we really should be looking at 2.4% stress that's either delinquent or been modified to avoid delinquency. So you are seeing very much that they are modifying loans to avoid delinquency. Come down and look at the all other loans, same pattern. Now the all other loans are a catch-all. Some of those loans are down here. For this bank, it's probably all ag. When you see a 0, that doesn't necessarily mean it's a 0. It's possible that the bank did not meet the threshold. This is variable reporting. I don't like it because it makes life complicated, but we don't know. We know the aggregate is basically up there. There's other loans out there, but we know that of the 17 million in performing modified, 14 million of it came from ag, 4% of their book. So you come into ag, you look at delinquencies, they're reporting $4 million. Up 1.3, 1.23, 1.23. Look at that growth, massive growth. Is it any surprise that you're going to start getting delinquencies? How are they dealing with the delinquencies? Is they're just modifying loans. They have modified 4% of their ag loans. Do you think they have 4% allowance on those loans? So if we look at their total portfolio stress, which is delinquencies plus extend and pretend, the number is 5.4% of their ag loans. These are ripples in the pond. We are seeing this increasingly in ag. You're seeing this happen. So asset quality, reserves. Are they well reserved? 1.57, 1.58, 1.59, 1.6. I don't look at that ratio. What I look at is reserves to NPLs. It's called a coverage ratio. This takes a look at how many dollars of reserves do they have against every dollar of adjusted NPLs. Adjusted takes out government guarantees. So that number is actually really strong, right? $4.77, it's up. Not as high as it was earlier, but very high relative to where they were for 10 years. But this was an improving credit environment. This is a deteriorating credit environment. But hey, 85% of the banks, according to this ratio, are less reserved than they are. But remember, that's not a real number. They're manipulating that number. You have to add in the TDR. So this bank, instead of being $4.77 for every dollar of trouble, notice how they're less reserved than they've been in a long, long time. So this is the danger of modifying loans. And they're not doing it in isolation. All the bigger banks, especially the publicly traded ones, this is the playbook. So Do I worry about their mark-to-market losses? No. But do I think that in a deteriorating credit situation with banks starting to have more delinquencies and more modifications to avoid those delinquencies would create a potential multiple storms, mark-to-market losses, and credit problems? Yes. Am I worried about Prosperity Bank? No. I don't see that their market losses are something that are bothersome to me. I am more worried about their ability to generate income off that securities portfolio. And I am definitely more worried about where they're going on their modifications. If that number continues to go up, we know that they're basically just extending and pretending, right? We know that they're just doing more and more to avoid delinquencies. As always, I appreciate your time. If you have any questions, please let me know. And I got to say it, YouTube videos, definitely. There's more content there, so please subscribe. We also are doing these pieces in conjunction with X.com and LinkedIn posts on the subject matter. There'll be more commentary with other banks on those posting each week. So anyway, if you have any more questions, any calls, or anything you want to ask, please reach out and give me a call. Thank you. Bye-bye.